In this video, we're going to review what self-employment tax is. I'll explain the exception carved out for rental income. We'll examine the difference between passive and active income. And we're going to take a look at some examples where rental income can become active and see what that does to self-employment tax. I'm Esri Bennett, and this is Bennett CPA. Self-employment tax is taxed on net earnings from self-employment of $400 or more. 12.4% of the tax is for Social Security, and 2.9% is for Medicare. That adds up to 15.3%. In 2025, once you've earned more than the taxable minimum of $176,100, you no longer have to pay the 12.4% for Social Security. However, once you have taxable income greater than $200,000 as a single filer or $250,000 as a joint filer, you have to pay an additional 0.9% Medicare tax. Now, it may seem harsh for a self-employed taxpayer to be taxed this high, but there are two things to consider. Number one, after calculating your self-employment tax, you can deduct half of it against your federal income tax. And number two, W-2 employees also pay this tax, or at least half of it. The employer will generally withhold half out of their paycheck and pays the second half for them. The employee's tax is still paid in full, but the employer takes half of the burden. So when you employ yourself, you have to pay the employee and employer sides, and the employer side is the side that is deductible. Rental income is excluded from the definition of net earnings from self-employment. Now, there are exceptions to the exceptions, like renting a hotel or an inn. If you're providing services in addition to the rental, that might be enough to invalidate the exclusion. But if you're a landlord doing the bare minimum, it's not subject to self-employment tax, and by default is a passive activity. You're either making passive income or taking a passive loss. Active income is usually subject to self-employment tax, and passive income is usually not. Generally, passive activity losses are limited to the amount of passive activity income for a given year. For example, if you have $10,000 in passive activity income and $15,000 in passive activity losses, then you reduce your passive activity income by that amount, and that $5,000 is suspended and carried forward into future years. There is an exception for real estate rentals. With real estate rentals, you can take an additional $25,000 of passive losses. So in the example above, if we assume those passive activities are real estate activities, then that loss is suddenly no longer suspended, meaning it can be deducted against active income. There's an exception to this exception. If you have adjusted gross income, or AGI, of more than $100,000, then you enter the phase-out range, where your deductible loss decreases as your AGI approaches $150,000. A common workaround for this is to try and have the rental income converted to active income. The most popular way to accomplish this is to qualify as a real estate professional. A real estate professional is someone who, number one, performs at least 750 hours of service in a real estate trade or business in a given year, and number two, those services constitute more than half of all the services they perform in a given year. If you qualify as a real estate professional, then you can convert your rental income from passive to active. This means that there's no longer a $25,000 limitation and there is no phase-out. You can take all of your real estate losses and apply them against your active income. This also means that active rental income cannot soak up passive activity losses. So, does this mean that your rental income is subject to self-employment tax? No, it does not. Rental income is not subject to self-employment tax even when it is active income. Rental income isn't exempt from self-employment tax because it's passive. It's exempt because it's rental income. Let's take a look at another example of rental income turning active. Self-rentals. A self-rental is a rental property which generates rental income at the expense of a closely held corporation. Self-rental income is recharacterized as active income against which passive activity losses may not be deducted. If the self-rental has a loss, then it remains as a passive activity loss and cannot be taken against active income. This is designed to prevent abuse of the tax code. Imagine a taxpayer who owns a corporation that generates a lot of revenue, and they have a rental property that generates a lot of losses. To avoid tax, they might consider separating the real estate from the corporation. and have the corporation rent to them at a gain. This would theoretically reduce the corporation's income and increase the taxpayer's passive income, which they could use to soak up some of their passive losses. The tax code does not allow for this. The tax code solves this problem by reclassifying the rental property's income as active. And when that happens, the rental income is still not subject to self-employment tax.